Allard, thank you so much for joining us today. Let's just get into some of the strength. Cited in particular has been the impact of cost cutting and a strong performance by stock market investments. It doesn't feel as though both can continue forever. So just give us a sense of the strength you're witnessing and what comes next.
Well, good morning to you. We are very pleased to report the quarter today. It is a good progress, the first signs of good progress of the transformation journey that Aegon has set itself out to from the Capital Markets Day in December recently. So we're off to a good start of the year. Indeed, operating earnings up 20%. A good progress made towards our cost reduction target of 400 million by the end of 2023. And we've reported today we've done 136 million of that. And we're seeing also commercial momentum building in our strategic assets. So we're off to a good start for the year.
You're the third company we've spoken to in the sector today, and what's jumping out has been the impact of low interest rates, but then that being offset by better pricing mix and inflows coming into the sector. If we do start to see some form of tapering, this extraordinary monetary policy tackled by central bankers, what does the next phase look like for your sector?
Well, I think the markets are in a discovery phase, I would say. They're trying to discover the post-pandemic world. And as you can witness from the last couple of days, there is some bursts of volatility surrounding that discovery process. Now, the fear of inflation is one. If inflation, however, translates into higher interest rates, that is good for our business. It is good for our products. It makes our products more attractive for our customers. And it also increases capital generation. So when inflation rates would translate into higher rates, that is good for us.
Can I ask you about the ongoing restructuring program? I know that you delivered a very solid statement to investors back in December here, but how far down the road are you on the program, and do you think that you will need to take out further costs here as you seek to improve operational leverage?
We have disclosed at the Capital Markets Day in December what our focus will be in the coming years for the perimeter of the company. And they will be in our core markets, which is the US, the UK, the Netherlands, and then growth markets, Spain, Brazil, and China, and then the global asset manager which connects the dots in all these businesses. All the remaining other businesses and ventures, we're running tight capital and with a bias to exit them over time. As part of that journey, we have announced today that we have closed the Stonebridge divestment and that we have divested Transamerica's venture fund in the United States. And obviously, we're also still in the process of closing the divestment transaction in Central and Eastern Europe and Turkey.
Yeah, obviously, all of this helps put money back into the piggy bank. Even as you're making disposals, though, and you are reshaping the portfolio, is there anything out there that you see that it would be worth adding as opposed to selling?
M&A may come back to the equity story as time progresses, but we are at very early stages of that. So we are really focused fully on executing the plan that we have announced at the Capital Markets Day. So at this point, M&A is not a priority for us.